the financial house of cards collapses.
They're calling it the Monday Massacre.
Points drop never before seen on the US market.
There are fears the sell-off will continue on Wall Street.
Everybody's invested, everybody's happy, everybody's making money. Something's wrong here.
This time is not different. 50 trillion. That's how much the global stock market could lose in a matter of months if the warning signs we're seeing right now play out. Recessions, layoffs, economic collapse. Every single time people say this time is different. Spoiler alert, it's never different. We're seeing those warning signs right now, and if you think you're safe, think again. In the next few minutes, I'm going to show you 7 undeniable warning signs that the market is about to crash, explain why it's happening, and most importantly, reveal 5 powerful strategies you can use to protect yourself. If you're watching this, you're already ahead of the pack. Stick with me and I'll show you how to stay ahead when it all comes crashing down. Let's talk about the 7 warning signs that are flashing red right now. If you've seen any of these signs, pay attention, because these are the exact same signals we saw before the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 Rona crash, and they're all happening again. Red flag number 1, cash is king. Right now, big investors are hoarding cash like it's gold. Money market funds, the safe place where investors park their cash, have hit a record high of 6.5 trillion. Why does this matter? Because we've seen this before. Investors stockpile cash when they sense danger. It happened in 2000, 2008, and 2020. And in every case, a massive market collapse followed. Here's what's wild. Even legendary investors like Warren Buffett are doing it. Buffett's company Berkshire Hathaway is sitting on a record $150 billion in cash. When the Oracle of Omaha starts hoarding cash, you should pay attention. Red flag number 2, surging interest rates. The Federal Reserve, led by Jerome Powell, has raised interest rates faster than at any point in the last 40 years. Why? To fight inflation. But here's the catch. They may have gone too far. Higher rates make mortgages, loans, and credit cards more expensive, and that's already crushing home buyers and businesses. Imagine this. A home buyer who could afford a $500,000 home a year ago can now only afford a $350,000 home because of the higher mortgage rates. That's how much power the Fed has over your money. Red flag number 3, positive real interest rates. Here's where things get worse. When inflation-adjusted interest rates go positive, recessions follow. It happened in 1990, 2001, 2008, and we're seeing this now going into 2025. Why does this matter? Because it signals that borrowing has become more expensive than saving. When people save instead of spend, the economy contracts. Less spending equals slower growth equals recession. Red flag number 4, corporate cash hoarding. Companies are hoarding cash instead of reinvesting. Why? Because they're bracing for bad times. Just look at Apple, Google, and Amazon. They've cut spending on expansion projects, slashed hiring, and increased cash reserves. Companies only do this when they expect turbulence ahead. Red flag number 5, layoffs are back. You've seen the headlines. Google, Meta, and Amazon have laid off tens of thousands of workers. And it's not just tech. Layoffs are spreading to finance, real estate, and manufacturing. When companies lay off workers, it's not because business is booming. It's because they expect earnings to drop. Red flag number 6, exploding consumer debt. Household debt has now hit 17 trillion, and credit card debt is at an all-time high. Here's the worst part, credit card interest rates are at 25 to 30%. That's the highest in decades. People are using credit cards to pay for groceries and rent, and with rising rates, this debt is only getting more expensive. Red flag number 7, the prevailing "this time it's different" mindset. This is the most dangerous trap. In the year 2000, people said, the internet is the future, this time is different. In 2008, they said, things are smarter now, this time is different. Every single time they were wrong. Now, I've shown you the warning signs, so let's talk about how I plan on protecting myself. This is not financial advice, just some things I've been personally doing. Step 1, diversify your investments. Don't bet everything on one stock or one asset. Diversify. Stocks, bonds, cash, and even gold. During the 2008 crisis, gold skyrocketed while stocks crashed. Diversification is never flashy, but it works. Step 2, build an emergency fund. Do you have 6 months of living expenses saved in cash? If not, start now. If you lose your job, this is your lifeline. During 2020, people with emergency funds stayed afloat. Those without them they struggled. Step 3, cut high interest debt. Credit card debt is a silent killer, and with interest rates rising, it's getting deadlier. Pay it down. Focus on the highest interest debt first, then move on to lower rates. Step 4, invest in inflation-proof assets. During inflation, assets like real estate and commodities often do well. During 2020, while stocks fell, gold and even Bitcoin surged. Step 5, stay rational. During every crash, people panic and sell at the bottom. In 2008, people sold stocks at a loss, only to watch them rebound a few years later. If you believe in the long term, stay calm, hold, and again, think long term. Watching your portfolio dip is brutal. It feels like real money vanishing in front of your eyes. And the fear, it's real. You start to ask, should I sell now and avoid more pain? That's human nature talking. But I've learned that acting on fear is a surefire way to lock in losses. Since 1950, the S&P 500 has seen over a dozen major corrections of 10% or more. But here's the kicker. Every single one of these declines was eventually followed by a recovery. Every single one. So why am I holding my stocks even when I think a crash might be coming? Simple. Time in the market beats timing the market. If you sell and try to time the bottom, you have to be right twice. Once when you sell, and again when you buy back in. And spoiler alert, most people won't even be right once. Consider this. According to a study by JP Morgan, if you missed just the 10 best days in the stock market over the past 20 years, your returns would be cut in half. Those 10 days often come right after the biggest drops, exactly when most people have fled to cash. And that's why I'm staying in. I like to speculate with a small portion of my portfolio, but with the majority, I'm not playing a short-term game. I'm not trying to win this month or beat this year. I'm playing for wealth in 10, 20, 30 years. And that requires patience, discipline, and a bit of stubbornness. Now, while I'm not selling, I am preparing. If the market crashes, I'm ready to go in heavier. I keep cash reserves. I'm not sitting on piles of cash just in case, but I do maintain some dry powder, funds that can be deployed if stocks go on sale. When high quality companies go on clearance, it's time to shop. When a crash does happen, people fall into the same exact trap we talked about earlier. They don't buy the dip because this time it's different. The stock market will never recover this time. This makes that mindset a double-edged sword. It will hurt you when the market is at its peak and when it bottoms out. Although I'm not selling off any major holdings, I can't help but think of Warren Buffett's advice to be fearful when others are greedy and to be greedy only when others are fearful. When I see the doggy meme coins starting to take off and reckless creative financing to buy Bitcoin from publicly traded companies, I can't help but to think that we are in a period where participants of the market are getting greedy. So as I outlined here, everything could come crashing down in the next few months or years, or nothing might actually happen. This is just a random YouTube video. It's not financial advice, but if you enjoyed it, please subscribe.